Coming to the foreign currency process. So, like what is this exchange for foreign exchange transaction? Why it is important and what kind of transaction we do in treasury module? Any idea? Any past
It's for
experience?
it's for month-end evaluation, right?
No, it is not month-end valuation. So in the treasury module, if you look at, let me show you, then may possible like anyone can foreign exchange transact. So this is the, you know, another transaction manager, foreign exchange. So actually, what is the purpose? What we do? Any idea? Anything if you have in your mind? Okay, so like let's understand about the risk management. Okay, because if I ask you what is risk management, treasury and risk management?
Through hedging, we kind of try to mitigate the exchange rate fluctuations or in future an option.
So let me take 15-minute session on this risk management, because we have completed money market, but overall objective of this treasury module is to manage the risk. And what kind of risk we manage in the treasury module, let's understand that. Okay, so the main objective of this treasury module, or you can say treasury department, is to manage the risk. Okay, now you will say what kind of risk. So normally if you look at the type of risk which are involved in our day-to-day business, is one is your interest rate risk. Okay, so this is the one type of risk, interest rate risk. Second is exchange rate risk, and third is called economic or political risk. So like when any corporate or any person invest in any company or start any company, the objective is to make a money, right? Earn a profit. But because of interest rate, exchange rate, or economic and political situation, you may not be able to earn, you may not able to get what you have planned. So how, just you understand this. First, we'll take the political and economic risk. Okay, so suppose you take an example of India. Okay, now if government says in particular industry, suppose you take infrastructure or pharma, government is saying, okay, now in India, anybody from anywhere in this world can come invest and start the business in India. It means like government would say, here we have single window clearance for all kind of licenses, support, whatever you want for to set up your business, it is available and government is supporting. Then definitely you will have a very good political and economic situation where other country may want to invest here. Definitely they will start investing. Okay, now suppose once you have opened the market for the global players, after 5 years, if government gets changed, so currently suppose in India I have a government of BJP and they have opened the market. In next 5 years, when once again election will happen and suppose some other government will come, do you think like similar kind of political or economic environment will be there? No. So when you do the business, you have to keep it in mind, if economic political situation change, how you are going to manage this risk.
Yes, right.
That's why. So suppose if government change the policy, then immediately like you have to, wind up your business or, change your business in the way government want, and that you have to manage. So that's the way, like, all the political, corporate house, they keep well connection with the government. If something, some investment they do, if you take India, like Reliance, Adani, they have a good connect with government, means they manage to run a government policy. What policy they is going to come, it's decided by the corporate. So this is the managing the economic and political risk. Hope this is now clear to you. Okay, coming to now our which areas which really we manage in the treasury module. Okay, and what is this, you will understand. Okay, now suppose you manufacture some XYZ product. So what I can say, suppose I manufacture laptops or mobile phone. Okay, and here first, before you do the manufacture or sale, first thing what you do the costing. Okay, so you do the costing, means what is the cost of this product and what is the sale price. Agree? So suppose if I say I would be able to sell particular variant of the mobile, suppose I have V1, cost I'm looking at, I'm going to invest 8,000 and overall I'll sell in the 15,000. So you say I am going to get the 7,000 of profit per mobile. Okay, profit. Now in this overall costing, in this costing, you will have what kind of cost you will have? You will have cost of the raw material, you will have the direct cost, and maybe you will have some interest cost, right? Because definitely if you do the borrowing, there will be an interest cost. So just I'm taking example. So suppose raw material I'm I have of 5,000. Okay, and direct cost suppose I have 2,000, and interest I have per mobile 1,000. This is my overall cost. Okay, cost breakup. Now this 1,000 interest cost, I have a kind of a facility or portfolio of the loan wherein my average rate of interest, rate of interest is 10%. Okay. Now average rate of interest is 10%. So suppose if my treasury department will manage to get the loans below 10%, if loan interest is below 10%, then your interest cost will reduce. But if it is more than 10%, then your cost will increase. So here cost reduction, and here you will have the cost increase. And believe me, suppose if this cost is going to be higher side, suppose if you have 200, 1,200, then definitely your cost will increase. Okay, so it will not be 8,000. And likewise, you can have multiple cost component. Now may possible, like here, like I have a profit of 7,000, wherein I have kind of common expenses, because like here just I'm considering the direct cost for the product. Suppose here my common expenses are there, that is coming as a suppose 6,000. So what is my net profit? Net profit is my 1,000 only, right? And now net profit is my 1,000. Net profit is my 1,000. So this profit definitely you will distribute among partners or whosoever has invested money. Now if you see, if the rate of interest is getting increased, your product cost will get increased, right? Likewise, if my interest cost will get reduced, then my profit will get increased. So here the risk management, where I say interest rate risk, the objective of the treasury managers is to look at what is my average rate of interest and whether I'm able to manage this rate of interest economically so that my contribution on the product will be maximum. So if you look at the large companies, if you take Reliance, the amount they earn from the treasury department, some of the company, they don't earn by selling their product. 40-50,000 crore, they, for 5-10,000 crore, they earn only from the treasury department by saving all these costs, doing investment in different area. They earn money, because here my interest cost is very important, because it has direct impact on my product. So this is called interest risk, and here you need to manage the interest rate risk. And how you can manage? So you can manage by doing the hedging. So what kind of hedging you can do? So you have to plan. Means suppose in India you have a rate of interest on loan is 10%, but if you find like outside India it is 5%, so you will see like how you can borrow money outside India. So you will hedge the overall loan. So I have seen, like in couple of implementation, if the Treasury Department find that rate of interest in India is higher, then somehow they try to get money from outside. So they will get money through the private equity. They try to get through the private bond issue. So somehow they used to get that money. So this is called the interest rate risk. Is it clear?
That sign of greater than less than is not correct. Loan interest, yeah, this should be around, yeah.
This is now correct,
Yes,
right?
yes, yeah.
Yes. Yes, I thought so.
Thank you.
This is now correct, right? So have you understood what is this interest rate risk?
Yes.
So this is the way, like when you have learned the money market and when you will do the kind of hedging transaction, so you will understand like why you are doing this transaction, because you have to keep the rate of interest minimum. Okay. Now coming to the exchange rate risk. Okay. What is exchange rate risk? So, like this cost, raw material, I'm saying this is my 5,000 is my cost. So just you try to understand the logic here. How you have arrived this cost? And suppose in India, so my local currency is INR, and I import all these materials. Okay, so suppose I import material from US. So, like import currency is USD. What is the exchange rate? INR and USD? It is, suppose currently it is 75 rupees. Okay, and in your costing, when you say my raw material cost is 5,000, it means like you have considered this some exchange rate between INR and USD to arrive this cost. Okay, so suppose like here, if I say how much, so suppose in one mobile I have considered the cost of 67 USD. So when I purchase all the raw material, the average price is 67 USD. Okay. For example, now when I'm actually doing my import and I have started my business, what are the probabilities are there? So here exchange rate, it may go up. So same thing, like here, it may go up from 75, reduce, or it may go up. So suppose in particular month, if my exchange rate is now 70, okay, and if some of the month if it is 85, then can you see like how much cost impact I get here? So if you see now, so when it will increase, you can see like my cost has increased by 600. Okay. But suppose if it is get reduced, then I'm getting this positive margin. So here you can see my cost has reduced by 300. And you can see like per, unit, if this is the cost reduction or increase you have, you can understand the level of impact. So how you can manage this risk? So here to manage this risk, you do the hedging, and the hedging is called the foreign exchange transaction here. So you can see foreign exchange transaction here. Normally we do the hedging, and what is hedging? You can understand. I'm going to take one example, but so far is it clear what is exchange rate risk and what is interest rate risk?
Yes, Hemant.
Any And in finance, normally what you do at the month end, we do very minimum transaction, that is called the revaluation of foreign exchange. Just you restate your financial. So if you try to understand the overall logic of this foreign exchange transaction. So here, what happens? First, let us take an example, then I will come to this treasury part of it, SAP. So first you understand like business process. So what happens? For example, like I have a raw material import order, import PO. I have issued a IRM import PO to suppose ABC company, USA. Okay. And here, for example, I have given order for, so PO value is suppose, this much of USD. Okay. And this is the USD, and consider my exchange rate is 75. So you can understand this is the value of INR. Okay. So this is my order. And you consider order I have given on 1st January 2022. And this is the exchange rate as on PO date. Okay. I have issued the purchase order. As a next step, if you see the overall my transaction, so consider like this supply will be completed in next 25 days. Okay. So order delivery 25 days, and then payment term is, you can say 30 days. So overall, if you look at due date, if you calculate, then it will be suppose 25th Feb is the due date. So on 25th Feb, you need to pay 10,000 USD to ABC USA. Okay. And sitting at 1st January, do you think like you can predict the exchange rate? Can you predict like what will be the exchange rate on 25th February? Any idea?
No, we can only guess.
Yes. And when you guess, what kind of guessing you can do? So guess, like when you actually guess, so you'll say, looking at current situation, exchange rate, I think it will be, one option you can say exchange rate will be 80 rupees, or exchange rate, you can say it will be 72, right? Suppose if exchange rate is 82 and suppose exchange rate is 72. Now you can see what will be the impact in your P&L? So here, in this case, you have a loss of 50 lakhs INR loss, okay? And here you have 30 lakhs INR as a profit. But now tell me, would you like to go ahead with this kind of probability wherein you can have profit or loss both? As a treasury department or as a owner of the company, would you like to take this risk? Tell me, like, if it is your business, then really would you like to go ahead with this risk?
No. How do we mitigate this loss? If it is 72, then we are good. Otherwise, we would like to stay at 75.
Yes. So what you will do immediately when you issue a purchase order on the 1st Jan, you will go to the bank. Okay. So you will go to bank. So you will approach to different bank, and you will say on 25th Feb, I need this amount, this much of USD. Okay. You will say, I want this 10 million USD. Sorry, 1 million USD on 25th February. What will be your rate? Okay. So here you will ask bank, give me the exchange rate of 25th Feb. Okay. So this is called the forward rate. So you will ask give me a forward rate of USD on 25th Feb. So bank will say, ask you how much USD you want to buy. So you will say, I want to buy 1 million USD. They would say, okay, I'll give you 76. This is my rate for the USD. Okay, and there will be some charge, very minimum. But normally, if you have a long-term relationship with the bank, they don't charge anything. Okay, so here bank has said for 25th February, let's have a contract, forward contract. I'm ready to sell 1 million USD at the rate 76. Now, if you do this contract with bank, this forward contract, your risk is now hedged. It is managed. If it is 80, then you can execute this contract. You can buy at this 76. So bank is bound to give you delivery of 1 million USD at the rate 76. But suppose if actual rate as on 25th Feb is 72, do you really want to buy at 76? No. You can say, if this contract to be expired. That's why here, like if actual rate. So actual rate can be 80 or 72. Okay. Now, if it is 80, then you will execute the contract, forward contract. If it is 72, then you will say, let it be expired. Okay. Bank will not tell you anything like why you are not taking the delivery of the currency. Because when you enter in the contract, bank will charge you the premium. This 76 rate, what they are giving you, it has all those charges included. So here you have option. You can buy the foreign exchange, or you can say, let it be expired. Okay. So in both cases, you have win-win situation, right?
Yes.
So this is called foreign exchange transaction in a treasury module. So normally what we are going to do for all kind of contract, like you have sale. In case of sale, instead of buying USD, I will sell to the bank, because suppose if I have sold material outside India, any product, I will get payment in USD. Now when you will get the money, actually you have to convert that USD into INR, then only you can use. So you can have a forward contract with bank to sell the USD. They will give you rate. Okay, if you say what is the forward sale rate of USD, they will give you that. So these are the very basic thing. Okay, then complex, like you have mentioned, like future options, those will always be there. Okay, but like this is the very normal transaction of
So we can have forward contract for both, either for buying or selling.
Yes. So normally what happens, it depends, like what is your hedging policy. Okay, so every company finalize form their hedging policy. So company may say like, okay, I want to take a hedging for sale and purchase separate. Okay, so you can say you can have a separate deal for sale and purchase. Otherwise, you can say like, I will take a hedging of net amount. What is net amount? Here, suppose if you have to sell 1 million USD and you have to buy, suppose 2 million USD. So net to net is 1 million purchase. So you can go and bank, you can say like bank to the bank, like I want to buy 1 million USD, because like like when you will get the payment, you can use that USD for payment to your vendors, right?
Okay.
So this is the way you would be able to manage it. But looks interesting. Have you understood the logic, like what we are going to do in this foreign exchange, right? And every month end. So here I have entered this contract on 1st January, and between 1st Jan to 25th February, I have 1 month end, right? So during the month end, so here at the month end, so like 31st Jan, in finance, you have run a lot of foreign currency revaluation transaction, right? So here bank will give you the actual rate of exchange rate. It's not normal like you go an RBI side and take the exchange rate. No, bank will give you for this particular contract what is the valuation. So you can do the valuation in your books to record your profit or loss on revaluation. So in the treasury module, you can run this revaluation transaction. Got it? So there will be a valuation process. And obviously, like when actually you will, close the forward contract, there will be a kind of realized exchange rate gain loss that will also come here. So whatever transaction you post in finance as part of foreign currency transaction, like unrealized gain loss, realized gain loss, that will also be applicable here. But here you will do the end-to-end buy and sell of the currency. So this is called the forward. Okay. This is called forward FX contract. But it is not only the forward contract you will do. You can do also the spot transactions as well. What is a spot transaction? Like suppose I have to, pay some money in USD. So what you will do, you will go to the bank and you will say, what is the spot rate? So you will have the spot FX transaction as well. Suppose if I don't take any forward, then obviously on 25th Feb, when it will come, you will go to bank and you will ask, what is the rate? If that day bank would say rate is 80 rupees, you are bound to take the exchange rate, with 80 rupees. Okay. So we will see a spot and forward contract both.
Hey, ZaranTech now offers SAP corporate training? That's right. Train your workforce in SAP with our comprehensive program. We offer customized courses, certified trainers, and hands-on labs for both individuals and businesses. Our standout features? Bespoke training, fully configured servers for practice, in-house materials, and a dedicated LMS. Plus, get session recordings and 24/7 support. From functional to technical modules, we have got it all. Choose ZaranTech for SAP training and watch your team excel. Learn, upskill, succeed with ZaranTech.
Okay. Now coming to our overall flow. So you can see here, for all the transactions, in Treasury, your business partner, creation of the deal, means order, contract, settlement, there will be no change. Okay. So never ever think like there will be any change in this. Only business requirement gets changed. So here the business requirement is different, but the steps are going to remain same as it is. There will be no change. So here we can see, like when in the SAP, when you enter any foreign exchange contract, so you'll create the order, and obviously before that you have the business partner and you need to assign the counterparty role. Then you have order, then you have to settle that. Once you will settle, like month end, you can do the valuation, like foreign currency gain loss and NPV value. So NPV value, bank will give you, this is the your valuation of your product, your contract. Okay. Then you can have this correspondence and payment. So this part F111 we will cover maybe coming week. Once we will complete the foreign exchange, I will show you how we can process the payments, and also we will cover some kind of correspondence as well. Means a standard how you can link the correspondence, that I will tell you. And then payment, if I have to make payment through Treasury module, then how does F111 transaction works? The way it's work in the finance, the transaction is F110. Okay, so here two steps, valuation and NPV is the additional one, you can say. Is it clear? For product type. So you can see like what I am said, there will be a month-end valuation, year-end valuation that we have to do, purchase, sale, all this thing we have covered. And then for the overall transaction, the trading, front office, back office, accounting, it is going to be remain same as it is. There will be no change on this. Okay. So now tell me, overall business process understanding, is it clear? Any confusion, any doubt in understanding the foreign exchange transactions? You can ask me any question. If you have not understood, I can take some different examples as well, but I can make you sure, like I will explain that.
So when company uses a spot contract?
Good question. If you don't have any forward contract, then it will be a spot only. Because suppose I have an import order, okay? Now 25th Feb, I have to pay money in USD. right? So you have to pay money in USD. It means like you are doing a spot transaction. Reason is you have account in INR. You don't have any account in USD. So you will go to the bank. You will ask bank what is the rate of USD. They will tell you this is the rate and you have to buy the USD. Then only you would be able to transfer the money in USD to your supplier.
Okay.
So normally in finance, you don't come to understand, like even you don't bother like how this money and monetary transactions are happening. Just you release payment to the vendor in USD. But Treasury department in the back end, they do the negotiation with the bank for the spot purchase as well.
Okay.
Clear? Yeah. Now coming to the accounting part. Okay. So we have covered the business process. Okay. So this is, you can say, business process. So if you understand the business process, it is very easy to configure Treasury module. And here we have accounting. So how this accounting will happen? That is important. Now tell me, like here you have very important date. Is that two dates are very important. Like one is contract date. So contract date is my 1st January, and due date is 25th Feb. Okay. When you have taken any contract, okay, do you think there will be any accounting in system? When I'm doing the forward contract, do you think there will be any accounting here?
No.
There will be no accounting. Very simple. And on 25th, do you think there will be any accounting here? So here I'm doing the purchase of USD. What will be the accounting entry? So very simple. At the time of execution of this contract, okay, on the due date, I would say bank USD, this is going to be a debit, okay, and then USD account is called, let me tell you in different way, then you will understand. Okay, so we need to break this transaction. Now tell me, like when I'm going to purchase this much of USD, and what is the rate? My rate is 76. So this much of USD I'm going to get, and this much of INR I have to pay. Okay. So here in the bank, so when I'm doing the purchase, there will be a two transaction, purchase of USD and payment in INR. Agree? So there will be a two transaction. First purchase in USD. So here I will say USD bank account debit. So in my bank account, I will get this much of USD. Okay. And here there will be a forward clearing account. Okay. So this account will be credit, and here I will say 10,000 USD credit. Then in INR, you have to pay money to the bank. So you will say bank INR. So you will say credit, and here you will say I have to pay this much of INR. Okay. And here once again forward clearing account, it will get debit. And but here the currency is my INR. Okay. So there will be a difference, exchange gain loss. This is called realized gain loss. Okay. I'll mention here. So what is this realized gain loss? So, in your SAP system, there will be an exchange rate. Okay. So when I'm doing this transaction, since my local currency is INR, so system will check in OB08 what is the exchange rate you have maintained. And this is the rate, my forward rate I have here. So may possible actual rate is 78 rupees. Okay. So here you will have, this is the amount you will get converted into INR here. Now you see, this is the exchange rate, and actually you have paid this much only. So you have realized gain. Okay. So realized gain, you will say credit, and you will say forward clearing account, how much? This much of debit. Now if you look at your overall financial, it is tally. So here you can see, like, this is my debit, this is debit, then USD account, this is debit, forward clearing, this much of debit, credit. Okay. Here forward clearing, this much of credit, or sorry, here this much of debit, and here also this is debit. So you can see, like, this is debit, this is debit, and this is credit. 0. So your financial also should, tally in all the currency. So this is the way accounting will be done. Tell me any doubt, or you have understood this accounting is clear?
Understood, Hemant.
Nathan? Yeah, so this is the way you have to understand the accounting. So once accounting is clear, so in our configuration, we'll do foreign exchange configuration, and we will try to simulate the same transaction. Okay. Let's see, like, are we getting the same result or not? Okay. How many of you are started thinking treasury module is simple? Have you started thinking this? Or still you think like this is difficult? Okay, so let's start this. So, our ADS template will remain same here. Okay, so if you look at the product type, so this foreign 60A, 60B. Okay. Okay, so normally you can take any, just a minute. Flow type, just let me see the assignment. Spot forward, netting, rollover, premature, fixing, and 60B spot forward, netting, rollover, premature, fixing. So overall, I can see both products are same. There is no difference. So we can take any product. That's not a problem. So let's take this 60A. So we'll create 601. Foreign exchange. So I am 10. So here you can see this is the standard product category of SAP 600, and then settlement. This physical exercise and cash settlement, like you need to understand, like when you do the treasury, so always you will find settlement type. So physical settlement and cash settlement. What happens? Like sometimes it happens. I'll give you an example here. Because in treasury, this is a kind of contract or transaction between two parties, and depends like how much comfortable you are with the other party, you can do any kind of transaction. So here you cannot go and tell client this is the transaction, this is the product, and the transaction should happen in this particular way only. You can't say that. For example, here we said, like if exchange rate is above 76, then you will buy, and below you will say you will not exercise that. But may possible sometimes you have favorable rate. Okay, now exchange rate is 78 rupees and you are going to buy the currency at 76. But for example, if your import order got cancelled, then what you are going to do? Will you take the delivery? Will you take delivery? No, you will not take delivery. It means if I say physical delivery, then this is the transaction applicable. It will work like this. This is called physical delivery. But you don't want to take the physical delivery. You say, boss, I don't want this USD. You just give me the difference. So that is called the cash settlement. So settlement type, physical settlement, where exchange of currency happen. Okay, so here exchange of currency will be there. Cash settlement, it is only a differential payment, either pay or receive. So that is called the cash settlement. So if I'm not defaulting the settlement type, it means I can select whether I want to do a cash settlement or I want to do a physical settlement. Okay, so currently I am not doing that. So 601 is my product type. Clear? Now coming to the next step. So here also we'll go for this normal transaction. So we'll say 60. Will not allow. So let me delete this. So we'll define the transaction type. Now, can you see the type of transaction type applicable for a foreign exchange? So I'll tell you like what are these transaction types are. So a spot transaction already we have covered, like on the date of contract or date of means on the current date, we buy and sell foreign exchange with the existing market rate, that is called a spot. Okay. Forward means is a future contract. Netting means suppose you have kind of buy and sell two transaction. Okay. So here you can do the netting. Like what is the net payable receivable? Then you have rollover. Rollover means, for example, I have a like due date for the payment is 25th February. Because of any reason, my import got delayed. It means I don't need this money on the 25th Feb. So I would need the money when actually my due date for vendor payment will come. So in that case, I can do the rollover. Okay. Premature settlement. So suppose like I have taken the forward rate and actually my import got cancelled. So I don't need this money. So I can cancel this contract premature. Then fixing. So fixing means you are just, what I can say, like you have, I need to give you some example. Fixing of transaction. So for example, like I have not taken the delivery of the contract. So I have option, I can do the, cash settlement, but that is also not an option. So I can just fix this transaction like, just a minute. Let me take some example if I get something so you can understand this. If I get it, fine, or else like when we will do the transaction, I will explain this concept. No problem. So we'll see. When I'll do this fixing, that time I will take the example. Currently, it is not coming in my mind. So we'll take that example. No problem. Okay. Normally, this is not very much applicable. So this 6 and 7 is not frequent transaction. And this is also not a frequent transaction, but this 4 is the spot, forward, rollover, and premature will be used in day to day. But like we'll copy all. So what we need to do, like we will select all. A spot is optionally not required. So we'll copy this and we will say 601. And here I need to change the number range. Okay. So all these transaction type we need to update in our so this is one important transaction. Assign forex attributes. Okay. Because if you look at the transaction type, these are the transaction types are applicable. But when actually you will do the transaction, so you can see here, like when I'm going to do the transaction 101. So 101 transaction, what is the exchange rate we are going to take? Okay. So exchange rate, what we are going to maintain here, that we need to update in the OB08. And then when I'm doing the rollover, that time system will show me like how much netting is happening and how much rollover is happening. Because, suppose here in my transaction, I have this 10,000 USD transaction. Okay. When I'm actually doing this rollover, may possible I will do the rollover for 50%, right? And 50% I will take the delivery, or may possible I will do the rollover of 1 million, right? So depends on the requirement. I'll do the rollover, and here the system will do the netting and rollover. So how much we are not going to roll over, that will be net off, and how much we are going to roll over for future date, that will be called rollover. And when I'm doing the premature settlement, that time also netting and premature settlement transaction will be called. So here for all the transaction, which transaction type will be called, all the settings are available here. So here just I need to select all this thing and just extend for your product type. And like here, the exchange rate is very, very important. Treasury department, normally they don't use the same exchange rate of the finance. They say like for my specific this transaction foreign exchange, they use different exchange rate type. Okay. So that's why here we have option to update the exchange rate type. This is done. Spread, coming to the flow type. So flow type, here we have very minimum flow type. Let's see. We will take this flow type example from here. You can see how many flow types we have here. 0010, 1000, 1031 and 2000. So if I go to the print, and you can see here, this is foreign exchange transaction charge. Okay, this is buy, this is sale, and this is the cash settlement. So when I will do the cash settlement, that time 1031 transaction flow type will be called. When I'm doing the buy, so this is the transaction, sorry, flow type will be called, and 2000 will be called when I will do the sale. Okay, just for all this, I need to make a placeholder here. And now you see here the parameters here. So this is the charges on the foreign exchange. Okay. So this is relevant for the profit and loss account, and whatever charges are applicable, it will update on the position as well. Sorry, it will be relevant for posting as well. Means financial accounting will be done for this. Then you have buy, posting, and relevant for position, and relevant for valuation, because I need to do the month-end valuation. Similarly, for the cash settlement also, same parameters will be applicable, and for the sale also, same thing. Okay, so let's extend this. Copy this, and here. Then we have update type. So update type, anyway, we are not creating any new update type. So here the standard, whatever update types are there, that will be used. So you can see here, these are the update types applicable for foreign exchange. Okay. So for the foreign exchange charges, definitely for the charges, it is inflow, buy, inflow, cash settlement, it will have the inflow and outflow both, and sale, it is outflow. So very simple. Like when you are buying the foreign exchange, it means like you are going to get the delivery of foreign exchange. That's why it is inflow. Okay. And when you sell, it is the outflow, means you will pay, you will give. Okay. And cash settlement depends on the rate. It can be positive or negative. So let's, copy this and update here. This is done. Okay, now once this is done, immediately we can go and do the setting for the valuation area. So for valuation area, it is going to be same 6010. This is done. And quickly we can maintain the account assignment reference as well. So all these steps are same for all the product types. Okay, and then derivation rule. So derivation rule is going to be same here. And also let's do the setting for the additional account assignment. Okay, so these are the standard settings applicable across all the product types and assignment of valuation area. So this I need to copy 102, 103, 104, 105, 106. Okay, so that's all. Now we need to do the setting for account determination. Okay, so now let us see the accounting entry. Sorry. So this is the accounting entry we have to do. So friends, here the accounting is very tricky. Okay, since we don't have that much of the bank accounts, USD, INR. Okay, so like option would be we can create this as a fixed account so that you would be able to see the transaction, how it is happening. Or like when I will say same account debit credit, so you can understand like how it is happening. So currently, like normally what happens, like I do the bank account setup the way we have done, and the wherever bank account is there, like this account or this account, it should get triggered automatically. Okay, so normally when I'm saying debit, it means like this is receipt account, so 3.2. Okay, this is the account symbol we use 3.2, and here it is a payment, so we use 3.1 as a payment account. So automatically based on the assignment in the deal, system should take all these account automatically, but currently we have only one bank account, so that's why this scenario will not work. Okay, but like you need to just understand like, okay, if like 3.2 or 3.1 is getting called, so I can understand this is a different bank account. I need to create one account that is called forward clearing account. Okay, so that account we will create here. I'll say FX So quickly, let's create this account.
What sets ZaranTech apart in SAP corporate training? It's our unique blend of expertise and innovation. We offer customized courses tailored to each client's needs, ensuring relevant, targeted learning. Our vast trainer database brings you wisdom from the best in the field. Need resources? Access our extensive training material repository anytime. We are all about measurable results, providing detailed student metrics to track progress. And we don't just teach, we build community. Join our thriving social media network, connecting learners beyond boundaries. With ZaranTech, you are not just training, you are transforming your SAP expertise.
Okay. So this is the account we have created, and then another accounts like here Forex, unrealized gain loss account, PNL, and Forex realized gain loss account. So I'm creating only one GL account. Okay. So let's so this is done. Now coming to the account determination. So before account determination, we need to list down like so many things. Okay, just so here I think like when you watch this video, you list down the steps, what steps I followed to configure any product. Sachin, Nathan, you follow that thing or not? Because like for some of the product, you need to. It's very very important. Define position management procedure. Okay, so like for the money market, we had used 2500, and at the start only I have said all the month end valuations are managed through the position management procedure. So for the money market, if my loan is in foreign exchange, then we need this foreign currency revaluation. In case of foreign exchange transaction, you have, if you look at here, you have two things. One is like when you have the, you can go to this here, so you will understand better. So you can see here, we have valuation, that is the gain loss at the month end, and you have NPV. Okay, so this two valuation type should be applicable. So let us see, like in the standard where I have this standard for the foreign exchange transaction, which one we can use that. Okay, so let's see here. Let me see FX. Amortization, security valuation, foreign. So we can create new, because amortization we don't need. We need this mark to market and foreign currency revaluation. Okay, these two valuation, two steps will be required. Okay, and let me see FX actual assignment. Let me see here. 600. What were the product? 600. Perfect. So here for this 600, normally I prefer to say like what the standard one. If something is there, we can use that. Okay. So for 600, you can see product type 600, it is 1401. So let's see in the 1401 what I have said, those value steps are applicable or something different is there. This one. Rate valuation, forward exchange transaction. Okay. Only one is applicable. Okay. So what I can do, I will take this. We can copy 14. I'll say 1410 FX foreign exchange forex transaction, and here you can see rate valuation forward exchange transaction. This is there, and second I can say foreign currency valuation. Why it is not appearing here? So a standard it is saying, let us see, like I will take this only, and then if something will not get evaluated, we'll cease to change that. Okay. So foreign exchange IN10. This is for my company. Okay. And here I will do the assignment. Six 01 1410. Okay. So once you have done this, you need to remember, like for the money market, we had done this transaction. So you need to remember two steps. So one is key date valuation and derived business transaction. Okay. So key date valuation, here you need to, extend the new PMP. So if you go to this transaction, you can see here 1401. And now I need to copy and, extend for 1410. In this key date valuation, you will find like here foreign currency valuation is there. So currently it is saying not applicable. It is saying, okay, not applicable, but it will be applicable. So you can see like when foreign currency will write up, write down, and here it is a reset. And most, important thing is like which float type you are going to, which update type you will use. That is also very known. You can see here V202. Okay. So here I will go. I want. Why there is no values? So I think these are the, but here you can maintain 203 will come, but we'll check like that update type is there or not there. We can see this, and here VR202, VR203. But let me check whether this is created or not update type. Here we can see this update type. It is there. And what about the print? And here assignment is not there. Okay, no problem. So just here I'm doing this copy, and like when I will get the actual valuation, that time we will do the GL account assignment, so that you will understand, like, yes, this is the update type and why we are using that. Okay. And then derived business flow. So derived business flow means the realized gain and loss. So here define, just a minute. Yes. For position management procedure, this is 1401. We'll copy this and extend for the 1410. Purposefully, I've created this one new PMP. Reason is, like, you will understand the whenever you will create the PMP, why you are going to create, and what are the steps, additional steps you have to do. Because money market, it's may be applicable, may not be applicable. Okay. So for 1410, realized gain loss. So you can see, like, here all the update types are there. But right now I'm not taking anything. Okay. We will use when actually we'll get the error. Okay. So this is done. PMP is also done. Next step is coming to the accounting entry. So in the accounting entry, very simple. These are the updates type we have. So let's see, like, what is the one for 200. FX 1000 positive buy settlement. So all position to bank account, because like here, if you see the accounting entry as well, we have bank account and clearing account. So position means your forward clearing account. Okay. Now we have to modify this posting specification. Okay. So here, if you see this one, our document type is TR. And here, like, if bank is going to be debited, so we know it is 3.2. Okay. Bank incoming and 422. So here I will mention 3.2, 422. Then we have 11,200. 3.2 and 1. Okay. And outgoing. So this is also correct. 1 and 3.1. Okay. Now for the account determination, for bank already we have done this setting. This masking is we have maintained here. For position 1, 1, this, and 6010. And for position, we have this clearing account GL. Okay. So we have maintained. Any question in the configuration? Any question, please ask me.
Not yet until I start reviewing again.
Understood? Okay. Now, quickly we'll create one transaction. So I'm not going to, complete that, just to give you flavor, what we have done so far. And when I will create the transaction, how it will look like. So step number one, always I will go to the BP and let's say use our BP. I think this is Citibank, right? Citibank. Okay. So we will use this Citibank. So counterparty, company code, and just here you check authorization is there or not. Foreign exchange not there, so I can give authorization. Okay. This is done. And then we'll go to FTR underscore create. Then here IN10 601 transaction type. So important. So I'm going to do the forwards. So 102. And this is my business partner. So you can see like here my screen got changed. Money market, there was different screen, and here we have different screen. Okay. Just a minute. Okay. So this structure you need to understand. So first step, what you should do, like we should go here. What we are doing here. So we are going to buy. Okay. So what we want to buy is USD, and what is going to be sold. So sale will be INR. Agree? So means I will pay in INR and buy USD currency. Okay. And how much USD we are going to buy? 1 million. And how much INR we are going to give? So what is my forward rate? 76. So like that we need to maintain here transaction. So here first rate. So rate between USD and INR. Okay. So USD INR. What is the rate we have agreed? 76. And what we are going to do? Buy. What is we are going to buy? We are going to buy USD. Okay. How much USD? 1 million. Okay. Now you can see currency INR USD. Okay. And if I say INR, sometimes I also get confused. Okay. Let us see if it is there. Okay. It is not there. So it is saying currency pair not defined. Okay. So it will be USD. I just have a checking whether it is there or not there. Okay. So here, for the currency, we need to define the lead currency. So let me see that step where it is. Not here. It is there between here, basic setting. So market data management, currency, define currency code. This is okay. Decimal place, check rate type. Okay, that is standard. Rounding rule not required. Define the currency unit, swap rate, currency ratio. M USD INR. It is there. There is one step is there, lead currency we define here. Currency unit. USD is there. Okay. There is one step is there. One transaction is there. Define a lead currency. Just a minute. And currency pair INR USD. I think here it is there one transaction. So for this M INR. If it will not work, we will stop. USD. Currency pair. M Diana 01/01/2022 1 INR USD equals 76 INR. See pair I forward. Okay, let me see. One transaction is there. General transaction manager. Define lead currency. So we did that, right? This is the. So do we have USD? So USD to NAR. So the settings are a small one, but sometimes we forget. Yes. So you can see here 1 million USD. So 76 is the forward rate. So it is showing my rate is this. Now we want to have this forward contract. Okay. So now contract date I will maintain as, sorry. So USD INR. So value date, we want 25th 02/2022. And here contract date, I'm saying 1st Jan. So swap rate I need to maintain. So swap rate is nothing but what is the rate we are. So swap rate, it is here. You can see swap rate. So it will give you message for 51 days swap rate. What it means between INR and USD, what is the swap rate is applicable. So here I will maintain 010122 and USD. So INR. Sorry. Okay. So hope this error will go now. Okay, then you can see here what is the spot rate. Okay, means what is the rate, what is the swap rate. So here I'm saying my actually forward rate is 76. Okay, but like a spot rate can be, it is suppose 75. So here 1 rupee I can maintain as a swap rate. So yes, sorry, this is maintaining it wrong. 76. And here I'll maintain this as a 76. Just a minute. So if my rate is 76, then system will find out like how much is my spot rate. So this is my spot rate, like what is the rate. And then second is what is the swap rate, means what is the charges bank is charging us. So that we need to maintain here. So once this is done, okay. So if you look at the cash flow, so you can see here, like on 25th February, there will be buy transaction and sell transaction. So buy transaction of 1 million USD and sell transaction of INR of 76 lakhs. So this is the accounting we had done. So you can see purchase USD and sell INR. So this is the transaction we will maintain here. And bank payment details, this is important. So you can see here, positive is USD and negative is INR. Okay. So when you maintain the payment details, you say positive USD and you need to maintain the USD bank and negative INR. So like that, you have to maintain the bank. Though I have only one bank account right now, but like you have to maintain the INR and USD bank different. Okay. So we'll maintain that. We'll create those accounts. So this is the way you have to maintain, because like here in the cash flow, you can see we have USD and INR. So payment details we have to maintain accordingly. Okay. This is the here valuation class, it is coming. Now, no need to do any update further. Just check if it is okay. Update type defined. Update type. Pen flows. Okay, I think some more steps are there. Something okay. Maybe this is not. So we will check this in the coming session. One more step, maybe it is there. So maybe we are missing that. So we'll check that. I think we have defined, okay. Just a minute. No. Derived business we did. So what is missing now? Okay, no problem. So this error update type, we will see like where it is. And then we will complete the transaction in the next session. Is that fine?
Yeah, that's fine.
Yes.
Okay. Okay, then we can conclude session. And I will try to, configure bank as well. Let me see.
Yeah, that would be good.